Coffee first. The way that securities market is structured involves the issuing of the securities in one market, which called primary market, and the trading of the securities in another market, which called secondary market. So let's talk about it. Hello everyone, this is Alex, and today we will try to understand the difference between primary and secondary market. But before we begin, I have a small disclaimer. Everything I say in this video or in future videos should not be considered as investment advice in any form. I have a certain license and certification that requires me to say so. So let's get started. The term financial market refers to any part of financial system that raises capital from bonds, shares and other investments. New stocks and bonds created and sold to investors in primary markets, while trade of the securities in secondary market. So let's start with an example that a new startup company needs money for its expansion goals, and it will be issuing a new shares of stock. Since the company is unaware of nuances of raising capital, it works with investment bank or investment banking division of the brokerage company. The investment banker will assume the role of the underwriter by agreeing, for fee of course, to market the shares to the ultimate investors. These investors could be investment companies, insurance companies, pension funds, as well as individual investors. As the securities are sold to investors, most or all of the money received will go to the issuer or corporation. Since this issuance marks the beginning of the shares' existence. This is referred to as a primary market. The primary market regulated by the SEC under the Securities Act of 1933. In the primary market, companies sell new stocks and bonds to the public for the first time, such as with an initial public offering (IPO). After the primary distribution of the shares, investor that purchased the shares from the corporation will inevitably want to sell them. The market that brings together buyers and sellers is referred as a secondary market. In the secondary market, the funds are no longer directed to the corporation. Instead, the securities and funds pass between investors. Let's examine some markets in which the securities trade. Exchange market. Traditionally, stock market were broken down into two categories. Physical trading venues such as NYSE or over-the-counter OTC marketplaces. Exchanges offers a centralized trading venue that functions as an outcry auction market. The auctioneer who controls trading in a given stock is called as a designated market maker. Today, the distinction between physical and electronic stock market is less important, since many stock exchanges have eliminated their physical trading floors. Nasdaq, which is one of the world's largest stock exchange, has always been the electronic trading venue, but is still classified by the regulators as an exchange. In addition, there are third and fourth markets, as well as ECNs, electronic communication networks, and dark pools. It's important to note that these are not available to retail investors like me or probably you, and we will discuss them in future videos. Ultimately, the main difference between primary and secondary market is who gets your money when you buy in shares. In the primary market, the corporation itself receives your money. In the secondary market, the seller on the exchange receives your money. The primary market, the place where securities are created, while the secondary market is where those securities are traded by investors. If you need financial consultation, please fill out the Google form below, and my assistant will contact you to clarify further steps. Thank you. Until then, spend your money well.